taking a look at a 9-system portfolio I talked about a couple of weeks ago. We're about to have a Brexit vote tomorrow. Britain will vote whether they want to stay in the EU or not. And so there's lots of anticipation and lots of choppy market conditions, so we've had a lot of chop lately. And so one of the things that we've had today so far is a soybeans trade. You see the strategy here. Soybeans day trader 3 got out on a tight trailing stop loss once we hit a certain profit target. So it was a nice trade today. One way to, for sure, when you're, all these financial markets are tied up in these news, tied up in the news of the Fed and the Brexit, and so it's kind of nice to trade a grain market, an agricultural market that's not, it's affected somewhat. All these markets are pretty correlated, and more than they used to be, but not as much. And so you're dealing with a soybeans market, and it's a little different than the other markets. So it's nice to have that diversity in the portfolio versus just all financials. You see we're short the bonds today, and so I want to take a look at the fills. We cancel replace to the market got filled at 167.10. The short signal is at 167.10, so there's no slippage there. And then take a look yesterday. We had a long trade, buy one at 168.05. We got filled at 168.05. Again, cancel replace at the market, and then we reversed. That trade lost. We reversed to the short side, 167.31. Sold and got short, and the fills, no slippage there either. So we get slippage in bonds, but we don't always get slippage, even on the limit orders. And so when you talk about slippage and commission factors, you don't get $31.25 on every trade. And so as a matter of fact, we had no slippage yesterday, especially on stop orders. So if half your trades are losers and you use a stop loss, then you can counter in the fact that half your trades you won't get any slippage on the exit if it's stopped out. So that's one benefit of a losing trade, is you don't get, if you're trying to be positive, you don't usually get as much slippage. You can in a fast market, but on a thick market like bonds, you hit the stop loss, you don't get the slippage. So we reversed to the short side, no slippage there. Took a manual exit a couple minutes early, cheated a little bit, I guess, instead of completely automating. Got out at 167.11, and the signal was at 167.12. So as far as slippage and commission are concerned, I don't know if there would have been slippage on that trade because I took the manual exit, but did better than average by getting no slippage yesterday and trading bonds. And so you don't always have to look at the worst case scenario when covering slippage and commission. You just want to calculate the average slippage and commission, and that's what we do. And usually $25 to $30 over all the trading systems will cover it. And so we're up 4 ticks on this trade right now. We'll see what happens. Brexit is at 3 a.m., 4 a.m. Thursday. It's during Britain's business day, and so the votes are supposed to be in between 3 a.m. and 4 a.m. Eastern time tonight. And so could be a lot of volatility, so be careful. I want to pull up a chart of the Swiss Franc and show you something. Here is a chart of the Swiss Franc, and back on January the 15th of last year, 2015, big, huge move on this daily chart. And I want to show you what that looks like intraday, and so I'm going to format that symbol to show that the last day is January 15th, 2015. And I want to show it on 5-minute charts. And so here is a gap. And a lot of times we think about gaps overnight or over the weekend. This is an intraday gap based on unexpected news events. So it closed at, the previous bar's close was 101.18, and then it started trading again at 88.94. And so you're talking about a 1,200 pip move and about $15,000. So had you been long at this point, and then the market traded again here, this is the forex, And so you could have gotten burned for $15,300 based on a future-sized contract, $125,000. So if you've been trading this, you'd have lost $15,300 in a blip. It's actually 4:35 a.m. to 5:30, so it was closed about an hour. This market closed, and they had some news based on the Swiss Franc, and so this is what you have to watch out for. Any surprises? I don't think that Brexit will cause this. This is one of the most anticipated events, and a lot of times when there's anticipated events, you don't get these. It's the unexpected events that usually cause this. And so if there's a big unexpected results, if Britain leaves the EU, then I think that will be the unexpected event. Right now, I think that is the expected event is that it will remain, and I think that stocks will rally after it. We're rallying going into it. We're rallying today going into the news, and so depending on how much we rally, if we rally a lot going into the news, it could sell on the news because the market, that would be good news for the market, and so they anticipate the rally. Let me pull up the futures for this too, because I want to show you the difference between the futures and the forex. So here is the futures. It's quoted the opposite direction as the forex, and so you can see, had you been short this market, you'd have had a better chance. It stayed the futures didn't close the way we see in the forex chart, and so the futures are, I've always preferred to trade the futures over the forex with my size account anyways, because I think that I get better transaction costs as far as slippage. And you see in a time like this doesn't close down, it continues to trade, and you would have gotten 200 pips of slippage here, which isn't bad. Or not, maybe not 200 pips of slippage, but had you had a stop loss in, you would have lost at most maybe $2,500 a contract instead of $15,000 a contract in the forex. And so you see the volume there is still kind of high right when that news was released, 5,600 up volume, 2,000 down volume. Then it starts to get light. So had you had your stop close enough within 200 pips, you would have gotten filled in here, and then this thing accelerated. So you see 212 volume, 212 and 31, and a huge move there, and then this move here, 25 up volume, 3 down volume, not much execution going on there. 400 pip move, and then this mega move right here, which was only 89 contracts, and you see a 1100 pip move there. So you'd have had more of an opportunity to get out in the futures than in the forex had you traded the futures. So that's one of the reasons why I like the futures. And again, back to what I was saying earlier, we're taking a look at the M&E S&Ps. Sunday night the market gapped up, and then it retraced, and then it's rallying again, and this thing could very well be 2100 again by the time the vote comes out. And if the Britain remains, the market could continue higher, or it could sell in the news. So that's what you have to watch out. If you're waiting to buy this as a bullish signal to know if Britain remains, the market could sell because it's doing the anticipated move. The forward discounting mechanism of the market is the good news is that Britain will remain. So the market's going to rally the way it would had the news already been released that Britain will remain, and then once it's released it will sell off. But I think overall this market is so strong, nothing can knock it down, that there is an overall bid in this market, so it could continue to trend higher even after that. And so it could explode higher as well, just because it's got the energy and fuel behind it per se to move higher. And so trade careful and make sure you don't get caught in one of those intraday gaps that I showed you earlier in the Swiss Franc, because they're not just overnight gaps. This is an example of an overnight gap, over the weekend gap, but the one I showed you in the Swiss franc um, was an intraday gap, and so you're not always safe with stocks in a big news event, or if they close the market and then release the news, or if it's a very fast event. So that's what I wanted to tell you about today. Be careful with the Brexit, um, and use good risk management. Some brokers have increased their margins. I think that it will not be much of an event, and I don't think there'll be huge moves. I think it'll be like an FOMC event where it'll just whip around. The news will come out and it'll just whip around, and then it'll die out into the weekend. And so that's what I anticipate. But anything can happen, so stay tuned.